welcome. My name is Jason Miracle, founder of RestrictedProperty.com. I am joined today by Ken Crabb, who is the founder and creator of the Restricted Property Trust. And he's agreed to spend a few minutes with us today to go through a quick case study. Ken, welcome. How are you, buddy?
Yeah, I'm excited to be here.
Cool. Well, let's get into it. I know we talked a little bit. We're going to look at a case study on a 55-year-old. Give us a little background on kind of the type of business it is, the reasons they did it, things like that.
Yeah. So, it's always fun on these case studies, talk about a really big, fancy cases. But where we live and breathe is going to be a 55-year-old dentist in Columbus, Ohio, making $800,000 a year, looking for business continuity and some tax mitigation. We do a trust like that every week. This particular case happens to be an oral surgeon in the Midwest. He's 55. He just got his youngest through college and had a 10-year run to retirement. And so he was really looking to do everything he possibly could to start saving these last 10 years. His kids are up and out. And he was saying to his accountant, hey, I'm maxing out my qualified plans. What else do you got?
Right.
And that is exactly this case. And that's probably, we did 97 trusts last year. I bet you half of them start like that.
Right. Right. Absolutely.
What else do you got? Because I'm running out of options. And this is classically that. This particular guy was making more than our average client. He was closer to $2 million. So 100,000 was a pretty easy number for him. But I would just encourage you all to look at this case study, whether it was $50,000 or $200,000, the actual math is the same. It's just it's linear.
Right. Right. Especially at that age. Obviously, if they're younger, we've got the benefit of time value of money. So it's going to be a little bit better in that situation, but you're absolutely right.
Yeah. If a 35-year-old is watching this 55-year-old presentation, his numbers, unless he's really unhealthy, will look a lot better.
Well, yeah, we just did one of these, you and I, on a 40-year-old. I mean, the number at age in year 25 was 150,000 tax-free for 20 years. I mean, it's insane.
It's crazy. Yeah, the younger ages are great. The only challenge with the younger ages is we have to be more sensitive to the amount of death benefit we're buying.
Correct. Absolutely. All right, let me pull this up on the screen so people can stop looking at my faces.
Yeah, when I get on the phone with any person who's exploring this employee benefit trust as a planning tool, I just want them to understand two things. The first thing they really, really need to understand is it's a 5-year commitment. There's no getting around it. You have to fund it for no less than 5 years. Now, I'm showing a 10-year commitment here because I am assuming that he will extend for another 5, but please know it's still only a 5-year upfront commitment. So he's not on the hook here for 10 years. And then it's as simple as this. I say, look, if you're in a 45% top marginal tax bracket, depending on your state and that sort of thing, you'd normally have to make about $190,000 to pay your taxes and have 100 left over. In the restricted property trust, because it's only 70% net deductible, I need an extra $24,545 to cover that phantom income tax, so I'm being fair. And what this spreadsheet attempts to communicate is, hey, do it or don't do it. Let's take a look at the don't do it. If you take the same $124,000 home and pay your taxes, and your local banker calls you and says, hey, you're such a good customer, I've got a CD paying 8% fixed for 30 years. Okay, well, let's take a look at that. And at the end of, you can see there at the end of year 11, well, he's got $874,000 in the restricted property trust. We have over $1 million. That's not a totally fair comparison because I still have tax liability. But after I roll out of the trust, we pay the tax for the client out of the policy proceeds. So that's not coming out of pocket. We can still take $65,000 a year out tax-free for 20 more years. And you would have to earn a little bit over 8% every year to match that. And the real question that becomes for the client, look, your money in the bank isn't paying close to 8%. Your rainy day money, most people with fixed income today are really hoping for 2 to 5%, 5% being pretty aggressive for fixed income. And the question then are the economics of this spreadsheet worth you locking your money up in 5-year rolling windows? And Jason, as you and I know, almost everybody says yes. It's just the amounts that change.
Right.
So if I have a client like this and he says, man, 8% with the free death benefit, that's a no, but it's a no 50,000. Okay, that's fine. It's not really our job to tell them how much to put in. The biggest job that you and I have is saying, okay, based on your facts and circumstances, we could get 50,000 in here. So you can pick up to that amount or any amount less.
Right.
And in this particular case, based on his tax return and his facts and circumstances and his reasonable need for a death benefit and frankly his age, I would have been able to get 200,000 in because I could have easily, there's a reasonable business purpose given his income and practice for over 5 million of life insurance. And he said, hey, this is great. This is a no-brainer, but for me, it's only a no-brainer with 100,000. Okay, perfect. And that's where we landed. And that's, and we got the case done. And this particular client's probably going to call me back 3 years from now and say, hey, Ken, I should have done more. And I'm going to say, yeah, it's fine. It's fine. It's doing what you wanted. It's just another bucket. And,
right.
The calls I've gotten over the past 20 years that I've learned from, I haven't had any of these recently, but it's the client that can do 200 and they decide to, and they call us 3 years later and say, man, I wish I did 100. That's a bad phone call because I can't fix that phone call.
Right.
So I am always preferring that people who choose to implement a restricted property trust, this shouldn't be a check to write. I hope it's big enough that they're excited about the tax mitigation, but that it's not so large that they're skipping dinners, skipping with their wife.
Right. Yeah. Well, and the other thing I always like to point out too, Ken, is, and you and I don't think demonstrate how important this piece is on top of this. Once we've taken all the withdrawals, we still have about $216,000 of death benefit, which doesn't go away. In fact, it typically, it's going to go up a little bit. I mean, not a lot, but it might jump to 230, 250.
Yeah.
And that benefit's going to go to the participant's named beneficiary, income tax free, in addition to all the withdrawals that were received.
You know what? Great point. And what's interesting, and you've probably seen these, well, I know you have, Jason, we've looked at this with qualified plans. And please know, I don't believe the restricted property trust competes with anything. It's just a separate bucket in my mind. It complements other planning. But if this were a cross-tested cash balance pension plan, which this particular oral surgeon was looking at and has, but when he gets to the end of his cross-tested cash balance pension plan, he's got to pull up 120,000 out to put 65 in his pocket. So yes, the qualified plan is going to have more money in year 11, but usually somewhere around age 78 through 81, the qualified plan has less money in it than the cash value of life insurance. And I've had clients look at that and say, yeah, but I have to be 81 for that to be true, for this to be a better idea. And my response is, well, no, if you die before 81, I've got a death benefit that's tax-free and always larger than your qualified asset account value. And if you live past 81, I win then too. So we win if you die, we win if you live.
And the reality is along those lines, is generally the contribution on behalf of the employees is going to be much larger than the 30% that you're recognizing on the contribution.
Correct. When I do my cross-tested cash pension plan comparisons, and I don't really even do them as much anymore because, again, I don't want to be seen as competing with that. Probably well over half of our clients also have a cash bound pension plan.
Absolutely.
Hugely in favor of diversifying. But yeah, for those clients, I run it at a 90% actuarial, which means the owner's getting 90%. And truthfully, it usually comes out in the low 80s, depending on the situation.
Right.
So most aggressive, I make the circumstances of the cash bound pension plan extremely favorable, and the restricted property trust tends to still outperform.
Right. No, that makes sense. I mean, did you want to make any other comments on this case study?
I think it's a perfect case study. I will say just one more comment quickly. my tax law firms did not used to like the solo medical practitioner case until one of the tax partners had his wife pass away, who was a dentist, and she was 48. And it was a brain aneurysm and a sudden passing. And they called, my primary tax attorney called me back and said, you know, Ken, if we'd had $1.5 million restricted property trust on her, my partner kept payroll going, could have looked for a new young dentist to come in and buy his wife's practice, and her life's work wouldn't have been up in smoke in a week.
Right.
And so the community lost a trusted dental practice, employees lost their jobs. And so all of a sudden, the solo medical practitioner and the need for continuity there became very real.
Right. And that's huge.
Yeah.
So,
Yeah, it was huge. It's a, not a great story, but usually we all learn from things like that.
right. Well, thanks for taking the time out of your day for this
Yeah.
case study. Hopefully we'll get a chance to do a few more and keep on moving along. Thanks, buddy.
Thank you, sir.